is not in itself is not bad, but it's making sure that the rate of return on which you're taking that debt on, the investment on that, the return on that investment is greater than the cost of borrowing. So knowing the basics like that is a good start in terms of building your the good foundations for building your financial wealth. Yeah, I would say most of all, spending within your means is a big one for me. Like the not feeling like you need to keep up with the Joneses or spend on the latest thing, being more mindful about your spending and making sure that, for example, if you were taking on debt, that you were comfortable with servicing that and to be able to absorb any negative shocks down the track.
Welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard. Oh, welcome Christina to another episode of Slice the Property podcast. So we like to kick things off by asking you about your first home buyer journey. What is it that you remember, Christina?
Yeah, so when I moved back to Auckland quite a few years ago now, I initially rented an apartment in the city and that really suited my lifestyle. So when I was looking for my first property, I bought an apartment in the city that's how, in terms of how I like to live and being central. So.
Yeah, location can be a big thing for definitely New Zealanders as well, and especially when you're in Auckland and you've got a bit of a commute ahead of you. And in terms of, I guess, home ownership, that's, one journey that you've had, but you've also got an impressive career and a shared love for economics, like myself. Could you tell us a little bit more about what that career looks like for you?
I moved to New Zealand with my family when I was quite young. And so being an immigrant and my parents first moving here, it was quite difficult initially for them to find a job. And so I saw firsthand, this was also in the early 1990s when inflation was very high. So and a lot of it now is, as an adult looking back, how scary a time it was for them being not able to find a job for a while, having savings in a time of high inflation and not really knowing how long those savings will last. So really it just highlights the damaging impact that high inflation has on savings. So for me, I enjoyed economics at school. The Reserve Bank here in New Zealand was the first central bank to introduce inflation targeting. So for my parents, the Reserve Bank was this great place, really prestigious and fighting the good fight in inflation. For me, I enjoyed economics, so I really focused on getting a job at the Reserve Bank once I finished my studies.
Yeah, I definitely thought about it for a time as well myself, because I studied law and economics and I loved monetary policy, fiscal policy, all of the things. Would you mind breaking down a little bit, if we go into a bit of detail around that, I guess specifically monetary policy and what that looks like in your role?
So as an economist, we always say there's lots of different moving parts, and that's especially so when you think about how monetary policy fits in with fiscal policy. When it comes to fiscal policy for the central bank, so say for New Zealand, if we take New Zealand as an example, they have a mandate to keep inflation within a particular target. Here in New Zealand, it's within the 1 to 3% target band. So what that means is that they have to think about what's happening in the economy, be able to project ahead and have monetary policy settings. So in this case for them largely the official cash rate. So interest rate settings which will then allow them to have inflation stabilising ideally around this inflation target midpoint of 2%. So this is where a lot of forecasting comes in, thinking about all the different moving parts that's going on in the economy, how that will impact on inflation and what adjustments they will need to do to interest rates in order to bring inflation back to the inflation target midpoint of 2% over the medium term. Now, what this medium term time frame looks like, it's a bit flexible for interpretation, but we will couch it as around a year to 18 months or so.
Yeah, and I guess just to sort of create context around that as well, so inflation being, directly impacting the cost of living, which is very front of mind for a lot of people at the moment, and just your groceries increasing in price because inflation being too high. So in terms of the official cash rate and how that's used to manage inflation and kind of temper it and reduce prices from continuing to climb. Can you talk a little bit about that official cash rate and how that's used as a tool?
Absolutely. So taking a household as an example, recognising that not all households face debt, obviously, but you would expect many will have mortgages. So when there's an increase in the official cash rate, so that's an increase in interest rate, then that affects what banks charge to borrowers, whether that's households in the form of mortgages or to businesses as a borrowing rate.
Basically just makes lending more expensive.
Exactly. So if you have debt, then that tends to, the costs of servicing that debt will be increasing. So taking where we're at now as an example, if there's an OCR increase, that tends to then increase the borrowing rate that banks go to charge to their borrowers. If for a household, they will face a higher mortgage rate. Now, given the nature of the New Zealand mortgage market, with only 10% of mortgages on floating rates, you do tend to see this impact quite lagged in the New Zealand economy. So often many households don't face this until it comes to the repricing of their fixed term mortgage rates, and that's when
I've got one of my mortgages coming off in March, so end of March I'll be settling on a higher rate, but hopefully based on the most recent announcement that it's on hold at 5.5%, hopefully that means that the rates that I'm being offered by the banks won't have climbed too much, and I've seen they've dropped sort of in the last week or so. So I'm hoping that news from the Reserve Bank has tempered the banks a little bit.
That's right, and that really, what we've seen over the past week, really highlights how important not just where the OCR is right here, right now, but also expectations of where the OCR will be over the coming years. The fact that with the latest announcement from the Reserve Bank, they've indicated that it will be a very high threshold for them to increase the OCR again, which means that it's unlikely. Of course, you can't rule anything out. The fact that it's so unlikely.
It was really positive to read though, and find actually, okay, cool, not only is it on hold, but also they're signalling that it's not going to increase anytime soon.
That's unlikely. So that in itself will affect longer term mortgage rates.
Yeah.
And that's where you see those movements coming in. So the OCR affects more the shorter end, and then expectations of the OCR are where you'll get that influence on the longer term mortgage rates.
Yeah, totally. One of my first roles was in foreign exchange at the bank, and I used to have to write like the weekly letter, and we'd be, in office waiting for the announcement, and I'd have to summarise what happened. So it's taking me back. I feel like I'm back at the bank.
Yeah, so the interest rates, here, what happens in New Zealand is also very important for where the New Zealand dollar goes.
Yeah.
And that's based on relativity with the interest rates in other major economies as well. So if, for example, we were to be more what you deem hawkish, and those expectations of interest rates are higher than where other economies are, then that will tend to put upward pressure on the New Zealand dollar. And conversely, if the other major central banks were to signal a more hawkish stance in having relatively high interest rates, then that tends to reduce the yield attractiveness of the New Zealand dollar and tends to put downward pressure on the New Zealand dollar.
Yeah, and that's interesting too, because with our economy being such an export-focused economy, sometimes the latter, when we see a downward pressure on the New Zealand dollar, that can actually be better for our economy in some ways.
Yeah, so that is one of the key channels that monetary policy works for New Zealand as well, the fact that we've got a free floating exchange rate. When there's any issues with the other major economies and you have a decline in the New Zealand dollar, then that tends to...
cheaper to buy our dairy and our other
so that makes
items.
our exports more competitive, and conversely it will make our imports more expensive. However, then that will tend to boost growth in our economy because of that shift towards more domestic production.
Absolutely. And moving back into the implication for property, and obviously we've had that announcement, which is, I was quite happy with it because, as I said, I have to refix soon. So as long as it's not up, down would have been great, but no one was really expecting that. But what do you see? Because you mentioned, the OCR itself really affects short-term rates, and then the commentary around that tends to affect the longer-term wholesale rates. Do you think that the banks have already probably priced in, when considering what their cost of lending is going to be for home buyers? Do you think they've already priced in a lot of that around interest rates, or might we see some further reduction in lending rates over the next wee while?
So generally, the longer-term interest reflects the expectations. And what we saw prior to this Reserve Bank announcement this week was that there had been a wide range of views over even just where the direction of the OCR will be. So that, in a way, probably held interest rates up higher than what then the Reserve Bank subsequently in announcing that they were unlikely to increase the OCR
Yeah,
further.
I mean, expectations were for a worse outcome, for home buyers, being that we don't want to pay more for our mortgages. Expectations were, I guess, a little dovish in terms of where things were going. But so in that regard, maybe there is still movement for some, positive or reduced lending rates off the back of the most recent announcement.
I would say so, given the fact that prior to this there had been some risk of increase in interest rates, and that is now removed. What we're seeing is that focus on when the next cut will be. There's never a dull moment in markets. It's always when is the timing of the next move. And now that the Reserve Bank has signalled that they're unlikely to increase interest rates any further, the focus is now turned to when they'll start cutting. So certainly with that more what you would deem dovish statement, then you do tend to see that put downward pressure on longer term interest rates.
Yeah, because basically the banks are thinking, okay, it might go lower in 2 years or 3 years. So perhaps we try and entice a few people to fix at 2 to 3 years so that they end up, paying a little bit more, we make a little bit more. And then you'll find the shorter interest rates potentially being a little bit higher because they think that you're probably going to get the benefit of any future cuts.
That's right.
I'm hearing that I shouldn't fix for too long, Christina.
Again, it depends on your expectations, and also I really want to highlight it depends on your circumstances.
This is not
as well.
financial advice, and there is a disclaimer at the end of the episode.
Exactly.
I'm just trying to pin you down, Christina, and get your advice on what to do with my mortgage.
This is where we roll out our stock standard line about where it depends on the individual circumstances and your preferences over whether you value certainty that comes with longer term fixed term rates versus the flexibility if you had the shorter term and you were able, for example, if you were expecting some extra money to come through in the short term, that you might be able to pay off your loan faster, for example.
Yeah, absolutely. And the other thing is, with rates where they are and from where they were when I first bought and when others first bought, there's also hang on, can I afford the 1 year rate? If it is that much more expensive, can I even afford to make those repayments? Maybe I have to fix out at 2 years, 3 years, because that's more, achievable in terms of the disposable income that I have.
That's right. And often the borrower will be guided by the bank as to where or what the level of debt that they can take on as well.
Yeah, totally. And we work with brokers and they support our buyers through that whole process. But I think it becomes interesting as well once you're in the home and then you go, what to do now. So a reminder that, there are brokers and advisors, or your bank can actually support you with that, and you're better to kind of get into those conversations before the day of fixing, I suppose, so that you can, as you say, consider your circumstances and work through.
Absolutely. The more informed you are about the choices you make and what those mean for in terms of your circumstances, then the better.
Yeah, we were talking off camera before actually about the importance of education and information and how that kind of really gives you an opportunity in and of itself to do better with money, to do better in property, and to just, improve your financial well-being. What do you think, share a little bit more about that and maybe what you'd like to see in New Zealand, because I think there is a real education gap when it comes to financial literacy.
So firstly, I would say it starts with the basics, the whole spending within your means, and then debt is not in itself is not bad, but it's making sure that the rate of return on which you're taking that debt on, the investment on that, the return on that investment is greater than the cost of borrowing. So knowing the basics like that is a good start in terms of building your the good foundations for building your financial wealth. Yeah, I would say most of all, spending within your means is a big one for me. Like not feeling like you need to keep up with the Joneses or spend on the latest thing, being more mindful about your spending and making sure that, for example, if you were taking on debt, that you were comfortable with servicing that and to be able to absorb any negative shocks down the track as well.
Like inflation and then an increasing an OCR rate
Exactly.
that's going to double the cost of your mortgage. Yeah, I think that's really good feedback, and it's really interesting because we have people come in and share different opinions, and that is what's so important. It is that actually it is circumstantial, it is based on your financial ability, but also on your preferences and your risk profile. And we get people say, actually, I want to take on the biggest loan that I can and stretch as far as I can and buy the best property or buy multiple properties so that I can grow that wealth. And that's a more high risk strategy, still a valid strategy though. And then what you're sort of suggesting is actually pulling back from that a little bit and maybe saying, actually, this is what's serviceable for me. This is what's, I'm not going to find myself in an awful situation where I'm unable to make repayments. So it's actually a more measured approach potentially where you're thinking, okay, things may change, the economic climate may change, how am I going to be able to manage in those different circumstances?
Absolutely. I feel it's really important to think about having some sort of buffer so that if you were to have any unexpected costs come up, for example, like the car breaking down and needing some major repair, that you have the buffer, the headroom to withstand those costs and not have it affect the other areas of your life, for example, when it comes to the ability to service your mortgage.
Yeah, because then it creeps into all areas of your mental well-being, your relationships and everything. So it's a downward spiral, isn't it?
That's right. Finances can be very stressful. So the more you can create some sort of certainty around that and be prepared for the wide range of scenarios that might come up, I would say, probably take a more cautious approach because of this, then that does tend to put you in a better space to absorb any shocks that might come up.
Yeah, I'm hearing that kind of come through, and it's great because we've probably had a lot of people that are a bit more hawkish, seen as we keep using. So to quickly recap on those terms, dovish meaning a little bit more pessimistic or like downward, and then hawkish being upward, being a bit more optimistic, a bit ballsy, and we've had quite a few ballsy people or hawkish people come through, so it's quite refreshing to actually hear someone, a bit more measured actually sharing their view and thinking this might, be important for a lot of our listeners to actually be a bit measured and think not just about what you want and what's exciting, but also what's going to set you up for a secure financial future, particularly when taking on a loan as big as what is required for a home.
That's right, because a home is often the biggest investment you'll make. So the more you can create some sort of certainty and some buffer around it, then the more, dare I say it, stress-free, not that there's such a thing, but it reduces
closer to stress-free, yeah.
That's right, it reduces the stresses that come with taking on such a large investment, committing to one.
Yeah, absolutely. And just to take a step up and out into a bird's eye view, I love a bit of macroeconomics. So when we think about the economy and how that's performing more generally, can we talk a little bit about how that impacts property? Like we've spoken about monetary policy as a tool to manage some changes in the economy and that, impacting mortgage rates, making them more expensive, making it harder to buy houses or harder for people to afford to service those houses. But what are some of the economic factors that we're seeing and that you kind of are looking at in your role that impact property day to day?
So in terms of, if we break it down to first principles, if we have a very confident, buoyant economy, then what that tends to do is people are in an environment where people are secure about their jobs, they've got high income, feeling good about the outlook for their employment.
Feeling hawkish.
That's right. And then that's when you're likely to have more demand for housing. Obviously, factors such as population growth plays a part in driving that housing demand. So generally, if you've got a buoyant economy, lots of people confident about the future, they're more likely to take on debt and also a larger amount of debt because of their confidence in being able to service that debt. And that's when you have the increase in housing demand, that increase in borrowing demand, and that will tend to underpin a stronger housing market. Also, access to finance plays a part in it. So if you had an environment where we saw over the COVID-19 pandemic period, where we had very low interest rates, that tends to encourage people to take on debt as well.
Are we going into quantitative easing soon? Or?
Definitely not, like at this point.
So I guess, there's a lending element to that though as well, like whether or not that's the economy performing well, rightfully so, say like we're doing a lot of the right stuff when it comes to our businesses, growing our economy, growing job opportunities, or whether or not some of it might be a bit more artificial, where we're enabling lending to the economy, or the government, which is kind of what I was talking about leaning into with quantitative easing, is the government giving money out. So whether that's benefits, or we saw a lot of that over COVID, and that's a bit of a short-term encouragement, sugar high to the economy, which then leaves us with high inflation. And here we are now.
That's right. So
there's a few factors then that you're
absolutely.
looking at.
So when we think about what's driving the housing market from a macro perspective, so a buoyant economy, people feeling confident about the ability to service debt, population growth, obviously, in the sense that people need to somewhere to live. So the more people you have in the economy, then in the country, then the more there's going to be demand for housing, and then also access to finance, whether that's through the ability to take on debt or the borrowing rate itself. So those are some of the key factors that drive housing demand. So if you think about conversely, where suddenly there was a contraction in the economy, people started feeling pessimistic, not quite sure whether they can service their debt anymore, their mortgages, that's where you have a pullback in the housing market. So that would be at a high level how you would see those factors playing out.
And that's sort of what we've seen over the last couple of years. Like I remember looking to go for a contracting role, and this is probably a good example of how, the factor over here flows through. But basically, I was looking at a role, had it lined up, and then this business was a bit uncertain all of a sudden about what was happening in the economy, so didn't want to continue with that. And I was okay with that. That was fine. But that sort of is a very real life example of that loss of confidence impacting the decision making, and then a reduction in hires, a reduction in spending, and then a reduction in confidence. That also means people are less likely to take on more debt. So that happened for a time, but we've had like a really interesting sort of period of flux where inflation has been high. And that confidence also separately, like that confidence happened before inflation got so high. The lack of confidence was there around COVID. Then the government pumped the economy with a whole lot of false confidence, money, sugar high as you called it. And now we've got inflation, and that's causing the higher rates, which is again, dropped confidence a little bit. But what do you see, like, as you said, it's a year to 18 months that you're really focused on that band of inflation and getting it back in line. Now, if we have seen the highs or the increases to the OCR, which is possibly what it looks like at the moment, then does that mean we're going to expect the housing economy to pick up again as we move back through the OCR cuts and lending rates being reduced again?
So if we're to look at what's been happening over recent months, we've come off a period of very high inflation, and with that high inflation, the Reserve Bank has had to increase interest rates in order to rein in inflation, and we are starting to see the lag impacts of that increase in interest rates come through across the broader economy. With that, we've seen that easing in inflation, and I've always talked about whether the key question for the Reserve Bank is whether this easing in inflation is at a fast enough pace for them to be comfortable that annual CPI inflation will return back to its target band 1 to 3% over the medium term. The fact with the latest statement just out indicates the fact they indicated they were unlikely to have to increase interest rates again, suggests that they are comfortable with the pace of this easing in inflation.
And I guess knowing that lag's there, right? Knowing that, sure, we've implemented this tool, for previously, but actually we haven't seen all of the hurt come through yet. We haven't seen everyone refix, and they're still going to be doing that over the next year. So there's going to be that lag out, for another year or 18 months.
That's right. So there's been an analogy used about monetary policy, such lag effects, as monetary policy being like a wonky hotel shower. So there you are, standing there cranking up the heat, and the hot water's not coming through.
And then it all comes out at once.
Exactly.
No.
So because you're thinking it's not having that impact, you're cranking it up, and then suddenly it all arrives and you get scolded. So I think that really highlights the dangers of overshooting if you were to respond to just what you're experiencing right here, right now. So it's important to take into account those lag effects and adjust your policy settings accordingly.
Yeah, and that's why on hold makes, a bit of sense then, because maybe they think that they've nipped it, but they don't want to cut yet in case that, they don't see that in the next 6 months or whatever it might be. But also, I guess, speaking about that lagging factor, I think this is really interesting because everyone that came through and was looking at houses end of last year started thinking, not everyone, but a lot of people were like, should I buy now though? Because interest rates are so high, it's actually cheaper to rent XYZ. But now we're seeing another lagging factor this year is rents going up, massive amounts. $600 per week I saw on one, we put it on our TikTok the other day, but on one property. So we're another lagging factor where sure the OCR changes, then over time the interest rates change, the mortgages get more expensive, and then the last factor in the chain of that is rent increases because the landlords pass that on. And so do you think that will be a continuing factor out sort of 2024, that those I guess that increased costs will be passed down to tenants?
To the extent that we've had such strong migration-led population growth, that will tend to boost housing demand. So we do expect that will underpin continued strong rental growth. When it comes to mortgages in the housing market and what that all means, now that the Reserve Bank has indicated it's unlikely to increase its OCR again, it does mean a bit more certainty over that interest rate outlook. And so it should mean that borrowers will feel more confident or comfortable, I guess, when they take on debt, that debt is not going to, the borrowing costs are not going to rise significantly from here on in.
Yeah, but I guess there's, for those that were waiting and thinking, it's just much cheaper to rent, there is always kind of a pass on to a degree of the landlord's costs. So I think that's really interesting to think about, and that might be why we're seeing more and more people come back into the market, because they're seeing their rent rise as well. And I guess you've made a really good point there around, a landlord couldn't do that if there were, 5 homes and 2 people looking for homes, but with 110,000 odd migrants coming to New Zealand, that's not the case. If you don't want to pay it, they'll find someone else too. So it'll be interesting to see how that keeps happening this year and whether or not that changes the way people look at buying property again this year. What sort of tips would you have for home buyers that are looking to get into the market in 2024?
I would say the enduring advice would be take on debt that you are comfortable with and that you feel you would be able to service and have some buffer to withstand any negative shocks, for example, unexpected costs that might come, or even potentially at any further increases in borrowing costs. The likelihood of that is unlikely, given that the Reserve Bank has indicated that it does not expect to have to increase the OCR again. But certainly having that buffer when you take on a large amount of debt, that will put you in very good stead for the coming years.
Yeah. And in terms of, I guess, at the moment it's looking like the OCR is on hold. Let's hope that it's reduced really soon for my sake. But what would you suggest when it comes to, picking interest rates or looking at how to structure your loan? Like there is the option to split your loan. What's your view on that?
I would say staggering is your mortgage so that you have different repricing points rather than whole chunks at any point in time. Then that is a useful way to then have that. Ultimately, let's face it, no one really knows exactly what's going to happen over the coming years. So being able to stagger that in some way spreads the risk of where interest rates will go down the track, gives you the flexibility to be able to manage the amounts as they come up, but not in one big lump sum.
Yeah, it's just, I guess, you're managing your risk you're diversifying your...
The interest rate
Yeah.
over that particular horizon. That's
In
right.
hindsight, I kind of wish I'd just fixed my first mortgage at 2% in perpetuity, like for 30 years. I'm like, that was a really low interest rate. I don't know why, as humans, we're just a bit greedy and we're like, what if it goes lower?
That's right.
But-
Could have, would have, should have.
Yeah, gutted now. I'm like looking at rates of 6% or something like that for the half that's coming off. But hey, that's just the way the cookie crumbles.
And I have to say, it is the fact that we don't have mortgages that are fixed at very low rates for very long terms that enables monetary policy to work more effectively.
Yeah.
Because
so I would have got you out of a job if I'd done that. You'd have been like, oh, there's nothing we can do. She fixed at 2%. She's hawkish as hell.
Because at the end of the day, the Reserve Bank does want to have an impact with the OCR increases, that it's the changes that it's making. So if you look at, for example, say what's over in the US, where you can fix mortgages for a much longer period of time, that's where you have those lag effects being much longer.
Yeah,
and the
like 30 years longer.
of the monetary policy, it just becomes that little bit harder to get it flowing across the economy.
Yeah, I guess you have to tighten the reins in other ways. Like if you can't do it with mortgages, it's business lending or, something like that. But it's a far less manageable, I suppose, system. Interesting, though. I've never thought about how they temper, activity over there and try and kind of pull the reins in when people are getting too confident.
Yeah, and then if you contrast that again to, say, the other end of it, where in Australia a much larger proportion of mortgages are on floating rates, then the impact of their policy rate decisions by their central bank, you see that flow through across the economy that much quicker.
Yeah, totally. Interesting. I guess it's just operating in different forms and the level of pain. I don't know if it makes much of a difference whether or not you experience that rate come through tomorrow or in 6 months' time, because as soon as the Reserve Bank is comfortable that activities, at a normal level and that cost of living isn't, ridiculous and outrageous, then I guess things will go back to normal a little bit. And I'd like to see that. I hope we do see a little bit more stability in the next kind of couple of years. What sort of advice would you have for your younger self, whether it's, financial, buying property, or even finding and choosing your career path?
I would say it's an interesting question. When I first saw that, I was like, oh, because while obviously there's been a lot of challenges, I do believe that every experience and challenge that I've had have led me to where I am now. So overall, probably if there was one advice to my younger self, it would be to be quite a lot more confident.
Be a bit hawkish.
Not necessarily hawkish, but have more confidence in my
do
decisions.
you feel like hawkish is a bit arrogant? Like it's
not necessarily. So hawkish tends to be more thinking about where interest rates will go.
Yeah.
So I would not.
I'm like taking an economic term and then using it in like a social context.
Yeah, and so I would say not necessarily hawkish, but that said, I do recognise the damaging impact of high inflation on the economy, just given with my experience when I was younger and seeing the impact of that, particularly when you have savings and not knowing seeing high inflation erode the purchasing power essentially of the money that you do have. So from that, I could say that I'm hawkish in the sense I recognise the damaging impact of high inflation, and I would think that high interest rates to head that off is quite important for the long-term sustainability of an economy.
Yeah, but I guess there's things you can do during periods of high inflation, which actually is put your money into property or put your money into, some sort of investment that's not going to be conquered by inflation. Because if you think it's just sitting in the bank account and inflation gets to 10%, your 50 grand is worth 25 grand over time. So I guess, it's back yourself, but it's also, maybe it's diversify your portfolio a bit and manage your risk in a way that suits your appetite.
Absolutely. You make a very good point, because I know New Zealand has this fascination with property as investment, so it's very concentrated in terms of investment. But diversifying investments is a great way to reduce the risk that you have for the same level of return. So by making sure that, like where possible, obviously, that you have the ability to have investments that you can diversify across the different asset classes, then that will allow you to withstand shocks in one particular aspect of the economy, where then it might be offset by another area.
Yeah, absolutely. And I think that's the thing. We are an economy in New Zealand that's driven by property and a desire for that. But I think part of that is because the economy enables it. Like, let's be honest. There's not, it's very easy to say diversify your assets, but if you want to invest in stocks, you can't borrow $800,000 from the bank to put them in there, whereas you can for property. So it is sort of enabled in our economy. Do you agree with that? Is that something that you see happening in other economies around the world as well? Or
I would say there's a wide range of things in terms of why New Zealand is so fascinated with property. The fact that with the shortage of housing, the return, the confidence that there will be a return down the track because house prices will keep rising. There's that mentality, that belief that because house prices will continue to rise.
And New Zealand's a popular place, so there's always going to be people wanting houses.
Yeah. So I always say with everything in economics, it comes back to supply and demand, and the fact that with supply constrained, the housing market being supply constrained, that's underpinning high house prices, and that belief that generally house prices will increase. That's where a lot of that interest in property comes in. Like you say, the power of leverage, being able to have with a deposit, being able to then magnify the return you get on that small amount of money because you're borrowing from the bank. But obviously you couple that with the belief that return will be magnified rather than a loss being magnified, because leverage works both ways.
Yes, so you've got to remember that, and you've got to be able to hold or manage those repayments. As you said, you've got to make sure that you are able to service it, that you don't take on too much lending. As you were talking, I was like drawing a supply and demand graph in my head. I was like, oh, so good. I haven't seen one of those in ages, and that's actually dead on, and it's a great way, coming back to economics, to think about things where it's just, if supply is there, then if supply outweighs demand, then there's, you're not going to make as much money. But if supply is below demand, you're going to make more money because you've got more power in the dynamic.
Yeah, so if there was the belief, for example, that you're going to get a supply response in response to high house prices, such that you don't have house prices going up forever and ever, then that will introduce a bit more uncertainty in terms of where investors feel they should be putting their money.
Yeah, I agree. And I think that, we talk about the housing crisis, and it truly does exist. It does feel unachievable for a lot of people. That's why SLICE exists, to reduce those barriers to education and to home ownership, and to help people get in sooner with as little as 20 grand. But I think the key, why do we have a housing crisis, is summed up with the one word: supply. There's not enough supply. We can't build fast enough. We can't build cheap enough. And that's sort of why the economy has enabled this obsession with property. So until that changes, I can't really see the way that we manage or engage with property changing anytime soon in New Zealand.
That's right. As given where policy settings are, it's generally, I can see why there is that belief that house prices will keep rising over the long term.
And, everything's subject to change. So hopefully we do get better supply. Hopefully the cost of materials, which skyrocketed since COVID, hopefully that comes back down, and legislation is there to enable more of that as well. But until then, I guess we just have to keep doing what we can and diversifying our portfolio as best we can. To finish off our episode, I'm going to ask you one last and very special question, which is, if your current home had a doorbell and that doorbell played a theme song, what song would it play?
Wow, that's a very interesting question.
Thank you. You were like, I don't know.
I don't know. I'm trying to think. Even my phone ringtone. Well, I have my phone on silent most of the time, and then even then, it would just be some generic ringtone.
You're just like, it would not have a doorbell.
But given I'm a total Swiftie, I would imagine it would be a Taylor
There
Swift
you
song.
go. There you go. You can't go wrong. You've just made about 1 million fans on this episode, Christina. Thanks so much for joining us. It's been great.
Thank you.
Welcome to Slice, Property Made Possible. We're a platform on a mission to reduce barriers to home ownership. This podcast is a safe space for our community to learn together and build the confidence required to start on their property journey. When you're ready to start, head along to slicetobuy.com and sign up for your free dashboard.